It's Canada and Toronto's real estate. An update just with the numbers so we can see exactly, what's occurring within the real estate market. And I'll show you in the future. Make sure you follow and subscribe. And I've heard I should suggest to hit the notification bell so you know when there's an update. I will be doing at least one a day, two if it's required. Again, this long wave is very complex, and so the thesis here is to simplify. But what I want you to see is how I forecasted, or the real estate was going to peak between 2022 and 2024. It was just regular buying demand based on historical demand and supply. Obviously, other things that affect it. I'm not here to suggest immigration is a policy or population growth. That is only one aspect. The most important driver of real estate is affordability. That is it. Everything else is meaningless. If we were to get 21% interest rates, nobody could afford to buy a home today because the income isn't there. No matter if there's potential demand. Now, if real estate prices collapse 90%, then that's a different story. So again, it's always affordability that drives demand. Everything else is second to that. Now, saying all that, I want you to see a chart. This is Canada's 5-year bond. And this telegraphs a big story. Look at it carefully. First of all, not only is it in log format, but you can see the secular monetary down wave within the contractive cycle, right? We had the secular fall in interest rates, and the monetary wave bottomed in August of 2020 at a record 0.3%. And guess what society did? They levered. Hence, we have or have had the greatest blow-off in real estate in history, and simply it's come from the zero bound. I mean, people are suggesting interest rates are going to go to zero. Okay, but Japan peaked at 6% and it fell to zero, and it didn't prevent its collapse, or the same thing in the Great Depression. We've already leveraged from zero. So that argument no longer holds water. The key is, and I'll tell you from personal experience, is what helps people and what helped me survive the 89-94 collapse is the mortgage that we originally financed, we were able to finance at a lower rate. So it was easier for us to eventually pay off the debt. If you've levered from zero or the zero bound, which much of society in Europe definitely did, how do you bail them out as interest rates are in an uptrend? So anyways, let's look at this again. And we can see the latest number, we're at 4%. It's following a secular trend business line into the Kuznets real estate peak in 2024. I'm going to update that. I'm going to show you the demographics, because the one aspect that I'm offering everyone is the real estate cycle, because it's the most important, or the Kuznets cycle is the most important to the down wave or the contractive cycle, right? The long wave, remember, as I've alluded to, it peaked in the 1970s, right? We had an up wave into the 70s, and since the early 80s has been a down wave, and the financialization of the economy occurred, and that's now ended. That's why I'm bearish on Canadian banks. But again, we take a look at, there's a rise here, and see that red line into 2024. That'll be it in terms of demand. And again, the demographic profile, I'll show you that tomorrow. Okay, so there's a lot of information. You can see the down wave. We've broken the trend. We see an up wave. It's still on trend. The 2024 is the peak. And the reason why I say 4.75% real estate collapse is that at that point, the continued rise in interest rates are just going to cause massive defaults because so many people levered from the zero bound. Now, here's the nominal prices. Excuse me, and this is from the BIS, and you can see two things that are most important. First of all, this is from the fiat monetary era, right? Another experiment that's eventually coming to an end, where We are using funny money. There's no sound monetary discipline. But notice the rate of change has been in a secular decline. And now it's over. If you could take that plunge of negative 15%, it's the greatest since probably since the Great Depression. So this is significant. Now, this is just nominal prices. We look at real prices, it's even larger, and it's not as great, of course, as the early 1980s. In the 1980s, but I believe that's going to surpass that. The 1980s interest rates at 21%. Yet this is just was the baby boomers were coming into. But that was the peak. By the way, in that period there in 1991, that was the start of the down wave, right? The falling price of credit, the financialization of the economy, the deregulation of the fire industry. See, when I worked in the invest business for 23 years, the banks weren't a major part of it. If you want to buy a mutual fund and you went to a bank, oh, that's too risky, you know, we don't do that. And now they're major players. What does that tell you? There's been a gradual deregulation. But again, the reality is this is significant. And I understand a lot of people think that this is going to continue, one more reflation. How? Canadian real incomes, Torontonian real incomes have been stagnant since the disco era. Real estate prices, very long term, fluctuate around inflation and incomes. It's just common sense. Other things can distort that. And what distorted that for 40 years was the falling price of credit. So we've had leverage in Ponzi finance. And as we saw in Japan, that eventually collapsed. Now, I understand that's hard for people to accept, which is fine, but there is a small group of you will understand the reality of that and will act upon it. Because economic winter means one important thing: surviving and protecting your assets. It's not about making money. Listen, we can make money, as I've alluded to, the Kennedys and Joseph Kennedy. The dynasty was made in the 30s, not in the 20s before. He saw what was coming and tripled his net worth. So we do that. And for those who are interested, I have a long wave model. Obviously, you know real estate is extremely bearish, but how to allocate over between now and 2040, I think when economic spring will start, it's going to be a challenge. There's no more markets will be going up, or they'll be volatile and sideways. Maybe initially after 2024, there'll be a collapse because we have the convergence of 3 cycles turning down, and I'll talk about that tomorrow. Don't forget to hit the notification bell if you're interested in that. Now, this is also interesting. What I did was, and I just separated, you know, Canada on the left in real home prices in Japan. So you can see a bubble, right? You can see basically that the whole asset bubble in Japan was erased. And I remember that time because not only did I buy real estate in 89, you know, you look at that little tiny bubble in 89 in Canada, and then we went sideways to down into 2000, right? That was a long bear market. And real estate was off the radar, except for a place to live, right? And that's all real estate should be. But unfortunately, society ignored history, and we're going to have a very bad ending, but not for those students of the long wave, thankfully. Okay, so we can see here, look, take a look at this. You know what's fascinating about this? In 2009, Japan's population has been falling. It's actually declined. They have no immigration, and they're aging rapidly, yet prices are rising. Why? Affordability. People are still buying homes, but prices have collapsed to the point, and their incomes are rising because there's a shortage of workers, so prices are rising. Here in Canada, we're having what? What's the whole story? What's the thesis? Immigration, population boom, yet prices are collapsing. Immigrants don't have the capital. They're causing short-term inflation because of this new demand for products. But then most of them don't have the income, and I don't buy the thesis. Sure, it's going to impact rents. But again, look, you're not looking at the bigger picture. What about the banking system as interest rates go up? they will have substantial losses. Anything below 25% correction, all banks are insolvent, all of them. And to suggest a 50% correction is within historical norms. Actually, it's going to be greater, but I had to be, not had to be, I've just said it cautiously, 50% is easy call. If you believe that is an extreme, you haven't studied history. I have access to every stock real estate bubble in history. And they're substantially more than 50%, because usually bubbles are built up on confidence and credit, not on real growth. Prove me wrong. I've asked people, they're always saying, oh, you're wrong. Okay, fine. I got no problem with criticism, right? Because you make me think. I have no problem. But when you say something ignorant like that, I always ask, look, provide the evidence, provide the proof. Please, I'd add it to my database. If I'm wrong, geez, I learned from masters, right? The masters were always correcting themselves, making sure that their head wasn't handed on a silver platter. These are the gentlemen that I learned from. So if you can show me one bubble in history, bubble symmetry, that hasn't collapsed, then I want to know about it. I've referenced every single one, and I'm documenting the ones, right? And we added 2 more last year, which was renewable energy and ARC investments. Even though those are rock and roll type of industries. What I mean by that, they're going to just change our world unbelievably, and that's a topic in the future. Anyways, I'm ranting here. Look at Toronto's inflation-adjusted home prices, right? Just updated yesterday. And there's two trend lines. Look at it. Prices were pretty good from 77 to 85. Then we had the collapse in rates, and I remember that. And then prices just tripled. Just people went crazy because interest rates. There you see the peak in 89, and then the price fall and ran into a 7-year bear market. And then we saw a trend line there from 96, and then from 2009 with the drop in rates, we had the blow off, as you can see, in 2022. By the way, there's no semblance of normality. This is the most important chart. Look at it carefully. What I've done here is I've adjusted home prices and income to inflation, taken it from the 70s when incomes were still rising. And those are recent numbers. So the 2023 is, of course, July numbers. There is the final blow-off of 17.8 times income. Look at the peak in 89, 6.7. We need, or we'll get a 50% drop to bring prices back to the peak in 1989, which went on to correct 25% and devastated real estate. Now, if incomes, read that. If incomes, real incomes, not nominal, rose 15% and real home prices rose 512%, how is that possible? Incomes drives everything, is whether you can afford things. I mean, most things are bought with cash. And if you don't have the cash, what do? You borrow. Now, if you can borrow cheaply, which has occurred in real estate for 40 years, that's what built the leverage, the unsustainable credit bubble, the big debt crisis, the super cycle of debt, the monetary economic winter from the contractivist perspective, whatever way you want to look at it, that's what built it up, and now it's reversing. But here's the thing is, again, look at it again. 15%, that's based on, and I've adjusted the income for Torontonians, right? 15, drop that in half, 7.5, we're still higher than the peak in 1989. And then you see where prices fell back to 4 or 5 times income, right? So 3 to 5 times income is historical norm. Prior to the women entering the workforce, it was actually half that. It was about 2 times, 3 times income. So that is why the homeowner, factory worker could purchase a home, go on a vacation, provide for the family, take advantage of technology because their wages were rising and home prices were reasonable. Today, in this beautiful city, where I live in Toronto, I love this city, but everybody's gone real estate mad. And that has to change, and it will change as the market corrects. So again, take a look at that, and eventually it's going to end badly. That's an easy forecast. Okay. As always, the Substack account, if you want anything in particular regarding the long wave model. So what I've done is that a lot of people said, Joseph, I just want the model. You know, the long wave is nice. It's a great theory. It works, but not interested. But I wanted to have one place where you could get everything. And of course, it's the website. And the website is, I'll be posting things so you can, if you learn, you want to understand how it works. So I'm not guessing. You can see that I have an enormous amount of data, probably one of the largest databases in the world. It's simply because I'm curious, right? I'm not brilliant. I've just learned from the best in the world. But some people say, you know, Joseph, this is nice. Can we just have access to the model, right? The long wave model? Sure. And the Substack will be now focused on that. It'll be so simply market focused, allocation, real estate, stocks, bonds, what sectors are hot, what sectors are speculative, where's the opportunity, right? It will shift according to the business cycle and valuations. Never are we going to be purchasing an overvalued asset. The model will be dictated by market forces, not by what I think. And that's why you see a discrepancy, why gold is going up, U.S. market's going up, Canadian market is in this bifurcated state. It's not sure yet, right? It's trying to figure out what's going on here. And I posted something interesting for subscribers about the banking index. And I've alluded to why the model is so bearish on banks. And if you understand technology, it'll make sense to you. Okay. So again, as I alluded to, please leave a comment. If there's something you're unsure of, or you want to challenge the thesis, it's okay. I got no problem. Oh, I just remembered. Yes, I want to pay attention to this. We're in a credit-based economy. We can't hyperinflate out of it because the bond market will prevent that. This is not Argentina, and I promise to do a short video on why this could never happen here. Simply, if you get interest rates moving to 10%, you would implode the real estate sector, which would implode the banking sector, which causes debt deflation. Argentina doesn't have a credit-based economy. So you have to understand the difference. It's always the bond market. Look, we've had a move to 3%, and it's 25% have defaulted. It just tells you where the leverage is and how sensitive we are to interest rates, right? And this is what ends credit bubbles, just to back up in interest rates because the leverage is so great and people are extrapolating that trend. So that's why it can happen. After you destroy the credit system, yes, you can hyperinflate, but it won't happen here. But after, that's why it's not my opinion. And also, by the way, I will do a video in the future, so make sure you have notifications on about the psychology of deflation, right? Proctor has a great theory on that, and Philip Fisher on the debt deflation of Great Depressions, which we're headed toward, unfortunately. But again, doesn't mean you have to, of why it occurs, right? And we've made the recipe for that eventuality, right? Governments can't do it because what can they do, right? We're not generating the economic growth to pay for all this debt. More importantly, what does central banks do? Create more credit to prevent a credit contraction, which means a bigger collapse from a credit bubble. We have to restructure the debt or debt deflation, and the consumer or the public will determine that ending. Anyways, I hope that was informative. We'll look at this. We'll have this information updated, of course, every single quarter. But obviously, as interest rates continue to rise, it will put another break, another default, unfortunately, into that real estate markets. And it's about surviving, right? That's the key. So we can't do anything about other people got caught up into making the mistakes of the past, right? I mean, It just blows my mind that a lot of people have done this, and we have access to the internet where all the information is there. Maybe they don't want to hear it. I think that's the thing is, right? Cognitive dissonance is a powerful protective force. But those people that are in denial, when they act, it'll be too late because the banking system will freeze and the ability to sell won't be there. I know from experience when I had to sell my condo, or the liquidity. And they will have to sell at a substantially lower rate than what they expect or even what the market will be if they have to liquidate. Anyways, I've said enough. Time is moving on, and I'll see you next time.